Welcome to TheoTrade. This is Don Kaufman. July 27th, 2020. Seconds to go to the cash close here on this Monday afternoon. With the Nasdaq once again raging forward by the tune of almost 2% for one of the first times in the marketplace. And this has kind of been creeping up on us, kind of, week in and week out. But really in the last 6 weeks, it's becoming very evident. And today, it's huge. The market cap now of tech stocks, it's totally overwhelming the marketplace. Let me actually display precisely why I'm making that particular statement as the markets are coming to a close here on this Monday. So net, again, we have the Nasdaq up by the tune of approximately 2%. If you cruise down the list of some of the usual suspects, a lot of what's driving, obviously, the Nasdaq today, once again, it's what we kind of term the monsters of tech. It's your Microsoft, it's your Apple, it's your Facebook, it's your Amazon, it's your Google. Again, we'll call them the usual suspects, if you will. What is in huge contrast, though, is we've seen these rotations, like out of the financials and, for example, into technology. And in that particular case, tech flies up, the financials come down, and the S&Ps skirt through the middle. And this is something I've explained just, time again, pretty much at nauseum, where, again, I want to kind of detail this. What we actually have going to the upside, for example, that would be like the QQQ. To the downside, this would be like the financials. And if the financials are not trading autonomously, the financials have been trading a lot with like the XLE. Nevertheless, if the financials happen to be the downside and the S&Ps, they can't, get going to the upside. Again, today, the financials, they're down by, 0.8%. That is not a small move in the financials, but the market caps now of big tech, and this is the first time I've really said this, they're actually overwhelming, the rest of the marketplace. And if you've never seen this before, I'll kind of give you a quick visual. If you look at the analysis of the S&P 500, it's just kind of a cool way to look at this. But analysis of the S&P 500, I'm just going to leave my mouse over here. The top 10 companies in the S&P 500. By the way, in the top 10, Google is listed twice. So forgive me. Let's go to the top 11 companies. Okay, they have a weight of now almost 30%. And all I'm saying here is, again, when I was talking about, in recent weeks, diversification, it's completely dead. It's totally evident now that the S&P 500 is literally being yanked to the upside when one of its biggest sectors, the financials, have actually diverged a little bit lower. To kind of further this a little bit, for those of you that do understand advanced decline line, and I was pointing this out a little bit in last week's trade too, but if you look at the advanced decline line, people, it's a slop fest. There's just not a lot of stocks headed to the upside. In fact, when we opened this morning and the Nasdaq opened up, 120 plus points, the advanced decline line was actually 65 decliners, and yet the S&P is also open to the upside. What does this mean for you? Well, same thing we've been saying day in, day out. It's just a concentration of market cap, concentration of liquidity. Everything right now is becoming about 5 stocks. And I guess the irony of that, the situation is coming to a head. Why? Because earnings are this week. And here's a really crazy one. They had to actually bump Facebook's earnings out. They had to bump them out to when? Oh, the same day as Amazon. Okay. Oh, wait, did I forget? Also the same day as Apple. So how about that? What do you have? Oh, $5-6 trillion of market cap, all having earnings on the exact same afternoon. What could possibly go wrong? You know what? At least we'll find this amusing. You'll probably get one stock to the upside, one trading to the downside, one right through the middle over here. Nevertheless, it is going to be wild when all your major tech stocks are lining up now. Did I not mention Google over here? So you got Google, you've got Amazon, right? Again, you've got Apple, now Facebook. They're all coming out on Thursday. It literally is becoming comical because these are the stocks that are driving all of the order flow to the marketplace. And what's the marketplace if not even the financials can diverge and drag us lower? Like, you have to realize, having 20 plus years in this business, people look at the marketplace, they're like, the Fed broke it, this broke it. No, let me tell you, it's all about the concentration of liquidity. If anything is broken right now, it's the fact that there is no diversification. And our biggest fear, okay, is that somebody like an Apple comes out and over the period of, let's say, 2 weeks, loses 30% of their value. The impact to the S&P 500 will be absolutely devastating. And that's not meant to be a scare tactic. These are definitive numbers that we're giving you here. In fact, in future iterations of these evening videos and during TheoTrade, I'll actually kind of take that example into real context. I'll show you what would happen if, for instance, Amazon had lost 30% of its value in a couple of weeks. What would be the impact on the overall S&P 500? And we can do just that. Now, okay, all the scare aside, let's actually look a little bit more detailed into some trade opportunities. One of the things that's, I think, on everybody's mind right now is also the dollar. So the dollar's getting crushed. Gold is exploding to the upside. I'm not as into gold as I am silver right now. Why? Well, first of all, silver, okay, it happens to have literally 68, 70 vol. If you compare that, and that's SLV, but if you compare that to something like GLD is a $182 product with like a 25 vol. There's nothing wrong with gold. I got no problem with gold, okay? But I'm not about it. Like I'm a trader. I'm always going to be a trader at heart, and I'm always going to look towards a little bit more volatility with liquidity. And I like the idea of kind of trailing silver with types of back spreads. And what I'm saying here, when I say trailing it, I'm going to put a back spread just in case it comes ripping down. I'm not saying it's going to come ripping down, but I'm going to be there if it does. And I'm going to tell you why that trade kind of works a little bit, at least works for me. If you come out here like 39 days out, and we actually pull up what's called implied volatility. Pull up the implied volatility. The skew is favorable to use back spreads. And that means, for example, you're going to sell these little monkeys in here, okay? And you're going to be buying these little monkeys out here. Why? Because you're selling like a 56 or 57 vol. You're buying like a 54 vol. The skew is actually favorable. What is something like that look like? Like when I say what does it look like, you sell one of these, okay? For instance, for like a $1.55, what do you want to buy? Okay? Immediately you can come over here. You can actually buy, all right, the 20 halves. It's for about a 21-cent credit. So what happens here? Well, nothing. If silver continues to fly higher, for the most part, you get to keep your 21 cents. If silver crashes and burns, it'll be there to pick up some of the pieces. Now, I actually have a couple of different back spreads on, but I'm also long a little bit of silver. So, that's actually the trade that I'm looking for in silver. The reality is, again, so the dollar's crashing, some of the metals are flying to the upside. I can't help but think, it seems like everybody in the business right now is talking about, I'll see gold at 2,000. It's a really crowded trade. I'm not saying that gold isn't going to get to 2,000, but I am saying, okay, I'll be there to pick up the pieces when everybody else is crying with my back spreads. And right now, again, the skew is favorable to put on that bearish trade, not because I want to get bearish, but because it's favorable to do so. And that's one of the things that's often missed, okay? That big time trade right now. Because again, gold, silver, it's completely and totally in play. The other thing I would actually look at right now would be VIX. All right, why would I look at VIX? Because that thing is lying dead on the floor. What is the floor? I think the floor is probably right around where it is. Okay, somewhere around that 25 level. This is kind of the lowest instance right here, right now. It's like the lowest instance of implied volatility in the S&P 500 since the onset of the Corona crash. So what do we got? I think we got a little bit opportunistic. I'd probably go out in something along the September lines. You can see I've got a lot of different positions on in here. All right, I'm going to sell a couple of these, for instance, buy a couple of these. What I like to do is I like to sell put spreads. And why do I like to sell put spreads? Because I think some bit of a floor is probably in here. But I would sell put spreads to buy way out of the money, just way out of the money call spreads, right? And I can come in here and, for example, I could buy these 50s, turn around and sell like something like the 70s against it. Look, this thing is for like 0. Here, if the VIX stays between 23 and 50, you're not going to make anything. You're not going to lose anything, but you're not going to make anything between 23 and 50. But between now and the September expiration, if the world falls apart and the VIX spikes up to 50 again, that doesn't look that far. But if it does spike up to 50, I'm going to be there once again to pick up the pieces when people are sobbing and crying. And I'm telling you, the trade, it's not done for a debit or a credit. It's actually done for what we term even money. Ties up a little bit of margin. Does it have risk? Of course. You know, what happens if the marketplace goes down to 15 in the VIX? You're like, oh, but still my heart. If it goes down to 15, you got yourself some troubles. Okay. But at the same time, if the VIX does go down to 15, hey, it is what it is. You probably are making money on some of your long positions out there. With that, yeah, you know what? The only thing to be thinking about the remainder of this week, you got the Fed coming up on Wednesday, yada, yada, yada. They're going to talk about yield curve control. Obviously, the biggest earnings day pretty much in the history of market cap. It is the biggest earnings day in the history of market cap. Will be Thursday after the bell. I'll be sitting here, okay? Well, I'll be sitting here, though, with my VIX trades just in case somebody has a little slippage over there. Let's hope that it's Facebook. Anyway, with that, thanks everybody here for joining us at TheoTrade. Have a wonderful evening. Bye-bye.